Imagine just a single solid cube of metal, and it measures just 20 meters across. I mean, you could comfortably fit this thing on a tennis court,
Oh, yeah, easily.
right? And that cube represents literally all the gold ever mined in human history, every single ounce.
It's kind of hard to wrap your head around, honestly.
It really is. And that single block, just, sitting there completely inert, is worth roughly $9.6 trillion.
Which is just a massive number.
Yeah. Yet somehow, this tiny physical footprint underpins the financial reserves of entire nations. So, welcome to our deep dive. I'm your ever-curious guide, ready to dig into the mechanics of the market, and sitting across from me is the analytical voice of reason, here to help us decode the broader implications.
Hello, everyone. I'm really looking forward to unpacking this one because we're looking at an asset that sits at this bizarre intersection of ancient history, modern geopolitics, and honestly, extreme financial psychology.
Totally. And just for the record, today is Friday, May 15th, 2026. And all the data, the historical analysis, and the primary market research we're utilizing today, it's all absolutely current, right up to this month, May 2026.
Exactly right.
You are tuned into Macroeconomy AI, and the title of today's deep dive is Gold as an Investment.
And before we get into the heavy lifting, we really want to thank you for joining us today. This broadcast is brought to you by our channel, Macroeconomy AI, bringing a compilation of analyses and news on macroeconomics, technology, and artificial intelligence.
Yes, and today's deep dive is also sponsored by Data Vault Analytics, empowering your portfolio with next-generation institutional data so you never miss a market shift. You can check out the links in our description to learn more.
Highly recommend checking them out.
So our mission today for you listening is to thoroughly examine the physical reality of gold. Right? We're going to look at this massive wave of institutional hoarding that's happening globally right now, the intense philosophical debate among portfolio managers, and of course, the very real mechanical risks of actually holding it.
Right, because, we really have to start with the physical reality. The limitations of the physical metal itself actually dictate its financial behavior.
Okay, let's unpack this.
Yeah.
Because for centuries, silver was actually the metal of daily commerce, wasn't it?
Yeah, exactly. If you were, say, buying bread or trading local goods in the 18th century, you used silver. Gold was reserved for something entirely different.
Right, which comes down to this concept of supreme fungibility, meaning, any 1 ounce of gold is virtually identical to any other ounce, no matter where you pull it out of the ground.
Exactly. It's atomic. It's the chemical element Ah.
But it's more than just being interchangeable, right? It's about this extreme resistance to corrosion. Like, you could pull a Byzantine solidus coin, which, by the way, maintained its value for 700 years, from a shipwreck after 1,000 years underwater, and it is still perfectly intact.
Yeah, try doing that with, well, pretty much anything else. Silver tarnishes, it degrades over time. Gold just doesn't. And that physical permanence transformed it into what we might call an indestructible ledger.
An indestructible ledger, I like that.
Right, because before digital banking, humanity needed a way to store the value of their labor across long periods of time without that value physically rotting away in a vault. The fact that gold cannot be artificially synthesized or, printed at will made it the ultimate anchor.
And this physical constraint eventually evolved into the bedrock of modern global finance, right? Specifically the Bretton Woods system back in 1944.
Yes. Under Bretton Woods, the global economy was essentially tethered to that 20-meter cube you mentioned at the start.
Which is wild to think about.
It really is. The U.S. dollar became the world's reserve currency, but the dollar itself was anchored to gold at a strictly fixed rate of $35 per ounce.
So foreign governments could confidently hold dollars, knowing they could just hand them back to the U.S. Treasury and receive physical gold in return.
Exactly. But, a physical peg is really only as strong as the vault backing it. By the late 1960s, the U.S. was aggressively expanding its money supply. They had to fund the Vietnam War, plus all the Great Society domestic programs.
Right, so they were essentially printing money.
Tons of it. There were vastly more paper dollars circulating globally than there was gold in Fort Knox to actually back them up. And recognizing this deficit, foreign nations understandably started demanding their physical gold back.
Which forced the infamous Nixon shock.
Right. August 15th, 1971. President Nixon realized the vault was literally going to run dry, so he unilaterally severed the dollar's convertibility into gold.
The tether snapped.
The tether snapped. And the international monetary system was forced into a fiat model. And, for those listening, fiat simply means the currency has value by government decree.
Right, and it relies on floating exchange rates driven by a nation's economic output and really just trust rather than a physical stockpile.
Exactly. So, freed from its $35 peg, gold's price was suddenly dictated by the open market. It floated into the thousands of dollars. So, if you want to understand its explosive financial behavior today, you really have to understand that this untethering turned gold from a stable monetary anchor into this volatile barometer of systemic distress.
Wow. Okay, but if it became a volatile barometer in the 1970s, why are central banks suddenly treating it like an anchor again? I mean, we have data from 2025 showing that central banks bought a staggering 863 tons of gold in a single year.
Yeah, the numbers are huge.
That marks 15 consecutive years of net buying.
Yeah.
And prior to 2010, they were actually net sellers. So what changed their minds? Are they preparing for doomsday?
Well, if we connect this to the bigger picture, the shift is really driven by the modern geopolitical landscape. And specifically, this growing narrative known as de-dollarization.
De-dollarization, right?
Yeah, to understand this, we have to look at the unprecedented financial sanctions that were imposed on Russia in 2022. When Western nations froze the Russian central bank's dollar and euro reserves, it sent an absolute shockwave through the developing world.
Because, I mean, those reserves were essentially just digital entries on a ledger, right? Freezing them just meant kicking Russian banks out of the SWIFT messaging system and forbidding Western institutions from honoring those digital claims.
Exactly. It proved that holding digital dollars carries immense counterparty risk if, say, your foreign policy misaligns with Washington.
Wow. Yeah.
So nations in the BRICS coalition, Brazil, Russia, India, China, South Africa, they watched that happen in real time. And they realized their national savings could literally be weaponized against them.
So they started accelerating their accumulation of physical gold.
Precisely. They view it as a sovereign shield. Gold is a Tier 1 reserve asset that operates entirely outside the fiat financial system. I mean, if China or India hold physical gold bars in a domestic vault in Beijing or Mumbai, no foreign treasury department can freeze it with a keystroke.
Right. So they aren't necessarily preparing for an apocalyptic doomsday. They're simply diversifying away from a unipolar, dollar-dominated financial system.
Exactly. Though we should definitely note that the United States still holds the largest official reserve by a massive margin, with over 8,100 tons.
Yeah, they still have the lion's share. But here's where it gets really interesting for you, the listener. Because if central banks are using it as a sovereign shield, the natural question is, should everyday portfolio managers do the same?
And this is where we see a very sharp ideological divide among the absolute titans of finance. We can sort of categorize them into two camps. The first camp fundamentally rejects gold because, well, it lacks an internal rate of return. Warren Buffett is definitely the most famous proponent of this view.
Right. I always think of the Buffett view as the apple tree versus buried chest analogy.
That's the right way to look at it.
You can buy a productive apple tree like a business or farmland that actually generates fruit or cash flow year after year. Or you can bury a treasure chest of gold in your yard. And the chest just sits there, doesn't do anything.
Yeah, it's an accurate representation of his argument. Buffett points out that buying gold relies pretty heavily on the greater fool theory. Because the asset produces no dividends, no interest, no earnings, your only path to profit is basically hoping that someone else will pay a higher price for it in the future.
Which is usually driven by fear or like inflation panic.
Right. John Bogle, the pioneer of the index fund, shared this exact same sentiment. He basically labeled gold as pure speculation rather than true investment.
But then you have the other camp, the treasure chest defenders, led by managers like Ray Dalio. I mean, Dalio built the all-weather portfolio at Bridgewater, and he actually advocates for roughly a 7.5% allocation to gold.
He does, and the thing is, he isn't arguing that gold is going to grow and innovate like some sort of tech company. He's arguing that you need a fire extinguisher when the apple orchard catches on fire.
Exactly.
Dalio looks deeply at historical debt cycles. His thesis is that when sovereign debt reaches unsustainable levels, governments just inevitably devalue their fiat currencies through aggressive monetary expansion. They have to pay off those debts.
They inflate the debt away.
Yes. And in that specific economic regime, high inflation and currency debasement gold serves as a necessary counterweight to protect your purchasing power.
But, does it actually protect you when the orchard catches fire? There is this fascinating academic study from Bear and Lucy in 2010 that rigorously tested whether gold is truly a safe haven during severe market crashes.
Oh yeah, their findings are a massive reality check.
They really are. They found that, yes, gold initially spikes when the stock market plummets, but that protective Inverse correlation only lasts for about 15 days of trading. 15 days.
The mechanics behind that 15-day window are super fascinating. Because when a severe market shock hits, investors panic. They execute a flight to quality, bidding up the price of gold. But severe crashes almost always trigger systemic liquidity crunches.
Meaning investors get hit with margin calls.
Exactly.
So if you borrowed money to buy stocks and those stocks are suddenly collapsing, your broker demands cash immediately to cover the difference.
Right. And to generate that cash, investors are forced to sell whatever liquid assets still actually have value. Because gold spiked during the initial panic, it becomes the primary asset sold off to cover those margin calls elsewhere.
Wow. So that intense selling pressure just drags the price of gold down right alongside the broader market.
Precisely. Breaking its safe haven status after roughly 2 to 3 weeks, it is a temporary psychological shock absorber, not some magical permanent shield.
So what does this all mean? If it fails as a long-term hedge during a sudden crash, we really need to look at what happens to it during prolonged bear markets. Because there's this pervasive myth that gold is a flawless, always upward asset. But the historical drawdowns are absolutely brutal.
People definitely suffer from recency bias here.
Big time. I mean, if we look at the period following the inflation panic of the 1970s, gold hit a peak in January 1980 of around $850 an ounce. From that peak to its eventual trough in August 1999, it suffered a 70% nominal drop. 70%.
Yeah, to understand why it crashed so violently, you really have to look at monetary policy. In 1980, to break the back of runaway inflation, Federal Reserve Chair Paul Volcker aggressively raised the federal funds rate. He pushed it to nearly 20%.
Which is insane to think about today. When you can get double-digit risk-free yields simply by holding cash in a bank or buying government bonds, I mean, the opportunity cost of holding a zero-yield rock becomes astronomical.
Exactly. Volcker's shock therapy restored global faith in the purchasing power of the US dollar. And as the dollar strengthened and those inflation expectations collapsed, the primary thesis for holding gold just evaporated. Right. It took investors who bought at that 1980 peak over 2 decades just to break even in nominal terms. And if you factor in the corrosive effect of 20 years of inflation, the real loss of purchasing power was even more severe.
Not to mention the opportunity cost. I mean, during the 1990s, while gold was steadily bleeding out, the S&P 500 was generating annualized returns of over 17%.
Huge divergence.
And beyond the severe price risk, there is intense regulatory risk. We talk about central banks using gold as a sovereign shield, but domestic governments can pierce that shield for everyday citizens. Take 1933, when President Franklin D. Roosevelt signed Executive Order 6102.
That is such a stark historical precedent. During the depths of the Great Depression, the U.S. government essentially mandated the confiscation of private gold.
They just took it.
Yeah, citizens were required by law to deliver their gold coin, bullion, and certificates to the Federal Reserve in exchange for $20.67 an ounce. And then, shortly after confiscating it, the government revalued gold to $35 an ounce, effectively devaluing the dollar overnight to stimulate the economy.
It just proves that during severe economic stress, the regulatory environment surrounding physical safe havens can shift drastically.
Absolutely. And today, we also have sophisticated physical risks. There are well-documented cases in the retail market of counterfeit bars. Forgers will actually hollow out a genuine gold bar and fill the center with tungsten.
Tungsten, really?
Yeah, because tungsten has a density nearly identical to gold. Unless you are drilling into the bar or using advanced X-ray fluorescence equipment, you might literally be holding a core of cheap industrial metal.
That is terrifying. Which, naturally invites the comparison to the modern digital alternative. The narrative that Bitcoin is digital gold has completely saturated the market. And the comparison really stems from algorithmic scarcity. Just as the Earth holds a finite amount of physical gold, the Bitcoin protocol mathematically dictates that there will never be more than 21 million coins.
Right, but algorithmic scarcity does not automatically equal safe haven market behavior.
Definitely not. When you look at how Bitcoin actually trades, its historical volatility is vastly higher than gold's. In almost every major market cycle so far, Bitcoin has exhibited a strong high beta correlation with risk-on tech stocks, like those heavily weighted in the NASDAQ.
Yeah, it trades much more like an early-stage venture capital investment than a 5-millennium-old monetary anchor.
Exactly. Though, to be fair, gold undeniably holds the historical track record for wealth preservation across empires and centuries.
It does, but, Bitcoin proponents rightly point out gold's massive physical friction. The industrial gold mining sector carries a very heavy environmental footprint. Current metrics show the industry emits roughly 100 to 120 million tons of CO2 equivalent annually.
It's a lot.
It is. The ESG challenges, the environmental, social, and governance realities of physically extracting declining grades of ore from deep underground are really substantial.
So if someone understands the macroeconomic history, accepts the volatility, and decides they actually want to interact with this asset, the mechanics of how you hold it change your risk profile entirely. It's not a monolith.
Yeah.
You can buy physical bars, synthetic ETFs, or futures contracts.
Right, there are options.
Let's use an analogy. Holding physical gold is like buying a heavy winter coat and keeping it in your own closet. Buying a gold ETF is like dropping that coat off at a cloakroom across town
Wow.
and holding a small paper claim check.
I like that.
The claim check is incredibly lightweight, right? It's easy to trade with other people. But if the cloakroom burns down or the manager goes bankrupt, your little piece of paper isn't going to keep you warm.
That perfectly highlights the core trade-off. Eliminating counterparty risk versus creating logistical friction. When you buy physical gold, the coat in your closet, you have zero direct financial counterparty risk. No institution stands between you and your asset.
But you immediately take on the physical burden.
Exactly. You have to pay for highly secure storage and specialized insurance. Furthermore, the retail spreads are wide, and, the spread is the difference between the dealer's buying and selling price. For physical bullion, a retail investor might lose 2% to 5% of their capital just crossing the spread.
Just to buy it. And if you opt for the claim check, the exchange-traded fund, you eliminate the physical friction. ETFs are highly liquid. You can buy or sell them on a brokerage app in milliseconds. And the spreads are incredibly tight, often fractions of a percent.
But you reintroduce layers of counterparty risk. With a physical ETF, you are trusting the fund manager's auditing, and you're trusting the institutional custodian guarding the actual vault in London or New York.
Right.
And it gets even more complex if you venture into synthetic ETFs or futures contracts. Synthetic ETFs often use derivatives and swaps to track the price of gold without actually holding the physical bars at all.
Wait, really? No bars at all?
Often, yeah. Which exposes you to the credit risk of the financial institution issuing the swap. And futures contracts involve leverage and margin calls, meaning you are betting on the future price action rather than holding the asset as a true store of value.
And on top of the structure, there's local tax friction to consider. For instance, in Brazil, treating gold as a financial asset on the local exchange introduces a 1% IOF financial operations, tax incurred right at the moment of acquisition.
Yep.
And if you later sell a gold ETF for a profit there, you face a 15% tax on those capital gains. The sheer friction of acquiring and holding the asset can significantly eat into your returns. And as a quick reminder for everyone listening, this breakdown of market mechanics, tax implications, and historical performance is strictly for your educational understanding. We are just mapping out how the financial plumbing works. This is not a recommendation or investment advice.
Very important point. Thoroughly understanding the costs of carrying an asset and the legal structures surrounding it is just as vital as understanding its historical price action.
Absolutely. Well, we've covered incredible ground today. We started with the supreme fungibility of the Byzantine solidus, watched the Nixon shock untether the global system, analyzed why modern central banks are building sovereign shields against digital sanctions, and examined why a 15-day safe haven effect collapses under the weight of margin calls.
It's quite a journey.
It is. But I want to leave you with one final mind-expanding question to think about. The entire core value of gold, the reason we trust it, the reason it acts as a ledger, is its strict earthly scarcity. You just cannot print it.
Right.
But what happens to the ultimate safe haven if humanity cracks the code on asteroid mining? If an automated probe successfully wrangles a near-Earth asteroid and suddenly introduces thousands of tons of new extraterrestrial gold into the global supply chain, doubling the world's reserves overnight, does the oldest, most reliable form of money in human history instantly become just another cheap industrial metal?
Oh, wow. That thought experiment strikes at the very foundation of how humanity assigns value to scarcity. That's a great question. But before we conclude, I must deliver our required legal disclaimer. This broadcast is exclusively for educational and informative purposes. No part of this content constitutes a recommendation to buy, sell, hold, or allocate any financial asset. All investments involve risks, including the potential loss of capital. Always seek qualified professional guidance before making any financial decisions, and remember that past performance does not guarantee future results.
Thank you so much for joining us on this deep dive into the mechanics and the madness of the golden paradox. We hope we've given you some fresh perspectives and a deeper understanding of the forces driving the market.
Thank you for tuning in. Keep asking questions and always look past the headlines to understand the underlying mechanics.
That was today's Macroeconomy AI. We'll leave it here. You all stay well and keep an eye out for our new broadcasts. Subscribe to our channel, access the links, and follow Macroeconomy AI on social media.